Property taxes and what every homeowner needs to know about them. This is specific to California. So if you're in California and you're a homeowner, this video is for you. Now, just to start with, California does cap your property tax increases at 2% annually. So your property tax bill should not and cannot technically go up more than 2% a year. But there are other ways that will increase your property taxes. And in today's video, I'm actually going to share what things can increase your property tax bills and some other things to keep in mind. If you haven't been to my channel before, my name's Darren. I'm a licensed mortgage broker here in Southern California, and my channel is dedicated to helping homeowners just like you build wealth through real estate education. Now, as I mentioned before, this video is for those people that are homeowners in California. And also, I'm going to be sharing some tips about if you're buying a home in California, what to look out for when it comes to property tax. Now, full disclaimer, I am not an estate attorney. I am not a licensed CPA. The content in this video is not financial or legal advice. It's information about property taxes, but consult your licensed CPAs, your tax preparers, and your estate attorneys when it comes to your specific financial scenario. All right, now when it comes to property taxes in California, let's start with Prop 13. So California's base property tax rate is 1% of your assessed value plus voter approved debt for things like local bonds. Now your assessed value usually starts at what you paid for that home, and that would be called your base year value. And this is allowed to go up 2% in California every year. Now, a word you must understand is reassessment. This means the county that you're in is going to reassess the value of your home. And this typically happens when property changes ownership, or let's say you buy a home, right? Then you would have a new assessed value, or if there's renovations or large new construction done to the home. But Prop 13 is also why your neighbor who's lived in their home for 30 years pays $3,000 a year in property tax, and you just bought your home for $1.4 million and you pay $15,000 a year in property tax. There's obviously a lot more to Prop 13, but I just wanted to give you a 10,000 foot view, just a quick summary of it. Now, I do want to share the moments that can make your property tax bill go up. Number one, when you buy a home, that new purchase price becomes the new base tax value for the home. And you can expect to pay 1% in base tax plus any other local bonds for your specific county. So for example, I'm in Orange County. Most of the homes here are around a 1.15% property tax rate. Now, the second way that your property taxes go up is if you build or you do a large remodel. And so the county will actually send you a nice little form asking you the estimated costs of your large remodel or additions. So if you've been on my channel before, you may have seen a video. We built an ADU in our backyard. So yes, we did get reassessed for the value of that ADU, which increased our property taxes every year. So if you're doing a large remodel, you pull permits, you're definitely going to get a form from the county asking about the new value added to the home. And if you do an SB9 or you build an ADU and you add these additional units, you're definitely getting that form too. So that's another time your property taxes will go up. And this one is actually more of a one-time fee. It's called a supplemental tax bill. Now, I'm including this one because one of my clients recently texted me. He bought his home, I want to say in May of this year, 2025. Here's the receipts, here's the screenshots. He's asking me about this supplemental tax bill. Now, most people understand the concept of it, but they don't always remember that's called a supplemental tax bill. Now, when you buy a home, there's going to be a difference between the old tax base and your new tax base. And that difference in that value, the county's coming for their money. Uncle Sam wants their money. They are going to tax you what's called the supplemental tax bill on that increased value on the home. Now, the tricky part about this supplemental tax bill is that you don't get this bill until 2 to 6 months after you purchase the home. So my client bought his home, let's say in May of this year, thought he was going to get this supplemental tax bill, and he's still waiting for it. And it's October already. And keep in mind, many of you have what's called an escrow account when paying your mortgage, which means your mortgage servicer actually collects your property taxes every month to pay for your annual tax bills. Now in California, we have 2 bills a year. Your escrow account, your mortgage servicer will pay that for you if you have an impound or escrow account. And this client does have an escrow or impound account. So he thought, oh, maybe that will cover the supplemental tax bill. But the mortgage servicer will never see the supplemental tax bill. You will have to pay that out of pocket. Now that I've shared all this bad news with you about property taxes, let me share maybe some good news. Prop 8. If your home's current value falls below its factored assessed value, you can actually request a temporary reduction. Counties call this a Prop 8 review. Now, if granted, the assessment can later go back up when values recover. So it's a year-to-year check. Now, this one is kind of good news, but also kind of bad news because this means the value of your home went down compared to when you bought it, but you do have the option to ask the county to lower your property taxes because the value of your home went down. And keep in mind, this is a year-to-year review. Now, let's talk about Prop 19. Now, this is going to be a big one in these upcoming years. Many millennials like me are starting to inherit their family's properties. So Prop 19 does affect this. Now, let me give you a quick summary on Prop 19 and how it works. Now, Prop 19 actually allows families to keep homes within the family and keep a low tax base. So as long as it's a family home or even a family farm, a child or eligible grandchild, if they move into the home and make it their primary residence and files the correct claim, they can keep the super low tax base. Now, if this home is a rental or a second home, most of these transfers now trigger a reassessment. And this usually leads to a much higher property tax bill for the person inheriting the property. Now, I'm just going to give a quick educational example. Once again, I'm not a licensed estate attorney or a licensed CPA, so it's not legal or financial advice. Just giving this for an educational example. So hopefully you can understand this a little bit better. Now, let's say the parents bought a home and the assessed value is $500,000. And now their son or daughter inherits the home, but the value of the home is $1.5 million. This is actually a pretty common scenario here in Orange County. And so now the child actually moves into the home, makes it their primary residence, and they file the Prop 19 exclusion, which actually allows up to a $1 million difference. So they actually get to keep the $500,000 tax base with no increase in this specific scenario. Now, let's say the property was worth $2 million and there's actually a $1.5 million difference. Their property tax base doesn't actually get reassessed for that full $1.5 million difference. It gets reassessed on the 500 difference above 1 million. However, if this child does not move in and make it their primary residence and the value is 1.5, they get reassessed to that 1.5 and their property taxes are going to go way up. Now that we've gone over some different California propositions that affect property taxes, I want to share 3 tips for you that could help you save some money. First, make sure if you have a primary residence, you are filing your homeowner's exemption. Now, this reduces your assessed value by $7,000 on your primary residence. You file it once with your county assessor. The second is to make sure you know what bonds you're paying for. So like I mentioned before, the 1% property tax base is the statewide number, but in your local county, look at those different bonds. So in Orange County, right, I would say the average property tax is like 1.15%. But if you buy a new build, maybe in Irvine or even in the Inland Empire, you could see your property tax bill up to 1.4 or 1.6%. That's a pretty big difference. And obviously, if you think the value of your home is incorrect and it's lower than what it is assessed for, go ahead and appeal. Now, on top of those 3 tips, if you are buying a home, please, please, please budget for your supplemental tax bill. I cannot stress this one enough. A lot of homeowners do not budget for the supplemental tax bill and they are caught surprised a couple months down the road. And if you are a lucky individual who is going to potentially inherit pretty valuable property, make sure you have a good estate plan in place, right? Make sure you are aware of the tax implications and you get ahead of it so you're not stuck with a huge property tax bill and stressed out when you do potentially inherit this property. Now, this is the 3rd time I'm saying this, but I'm not a licensed attorney or tax advisor. So please, if you have questions about estate planning or taxes, reach out to licensed professionals. If you don't have any licensed professionals, you can email me at darren@realdarrensci.com. I can put you in touch with the ones me and my family personally work with. As always, thanks for watching my videos. I hope you learned something new on this video and this video helps you, and I'll see you on the next video.